The Alpha Horizon. Thinking different, acting aware.
In response to the pandemic, governments and central banks have poured trillions of dollars into the economy. This means that their funding instrument, treasury bonds, has been pushed to record low yields, and today investors face the risk of rising inflation rates as the economy recovers. Are safe havens still safe? Today we'll discuss this and the implications for portfolio construction and asset allocation. My name is Alberto Gallo, portfolio manager at Algebris Investments.
How do you define a safe haven asset?
Safe havens are those assets where investors can turn to in moments of crisis. Essentially, it is an asset that you trust and that's going to preserve your capital even if times are tough. Today, we see that investors are starting to doubt in the capacity of government debt to preserve capital. Instead, we see the price of assets that have no cash flows but are in short supply, like digital art or football rookie cards or collector's sneakers, going through the roof. This is a symptom of a very fragile market in our view. While central banks over the past decade pushed government yields to record lows with quantitative easing, today, governments are starting to spend as much as possible with the first biggest deficits on record since World War II. With the approval of the Biden administration's $1.9 trillion stimulus plan, the US spending since the COVID crisis last year has gone to around 20% of GDP cumulative. In the second quarter, we expect more stimulus coming with the infrastructure plan. This is a reason to worry for many investors that have put their savings into bonds at between 0 and 2% yield across the world, and that today may see their savings eroded by a moderate level of inflation, which could reach between 2 and 3%. Therefore, not only risk-free assets are money-losing assets today, but they could also reprice wider, exposing investors to mark-to-market losses. In other words, investors only have two choices here if governments continue to spend. They can either lose money quickly in a repricing of yields, or they can lose money slowly against inflation.
How is the pandemic still impacting the pillars of asset allocation?
One of the key assumptions of portfolio construction is that investors can pick between risk-free assets that are relatively safe and risky assets that give you a higher return. But the key is that these two assets generally move in opposite directions. So during a crisis, for example, stock prices would go down, but the price of US Treasuries would go up. This negative correlation has worked very well, particularly post the late 90s, when inflation was under control and treasuries were even safer considering the limited risk of inflation. However, the current fiscal action by the US government threatens to reintroduce the risk of persistent inflation. And in addition to this, central banks over the past decade have been buying treasuries and credit, and in some cases equities as well, all at the same time. And what this meant is that when QE was being implemented by central banks, this liquidity would lift up all the boats. While on the other hand, when central banks reduce their stimulus, all the boats are coming down. We have seen this already in 2018, in 2020, during the COVID crisis, where the price of stocks and treasuries went down in tandem, and we are seeing it more slowly in 2021. Essentially, this means that the typical 60-40 bond equity portfolio is not as good as it used to be. The diversification benefit of having typically what were risk-free assets in a portfolio is not as good as it used to be, and therefore investors need to think of a new type of asset allocation and portfolio construction. Instead of buying a treasury fund, a high-yield fund, and an equity fund and mixing the portion of these, they need to think about strategies that already implement protection and hedges and that can protect capital by themselves when there is the risk of a crisis.
How can investors find value in this environment?
1 year ago, at the start of the COVID crisis, we published an investor letter titled "There's Nothing Left to Sell." We had plenty of opportunities across all asset classes as investors were hit by a sudden stop, by a panic around the economy. And there was plenty of value across both government debt and corporate debt, as well as equities. Today, Thanks to the intervention of governments and central banks, the economy is recovering, but at the same time, financial markets are priced already for a much better outcome. Therefore, we need to be a lot more selective. Firstly, when it comes to government debt, we think there is negative value for investors. In other words, you are paying to have a store of value, to have a safe haven, which offers you less than inflation across most jurisdictions. In the United States in particular, we see the risk of rising stimulus with the Biden administration pushing US Treasury yields even above 2% in 10-year maturities. This means more mark-to-market losses for investors. But even in Europe, where the Bund is still at minus 0.3% in 10-year, we see more stimulus from the European Commission driving Bund yields at least to around zero. If investors get a little bit more return from corporate debt, however, especially in investment grade area, we see still the risk of rising yields as a threat. And even though there is still a certain amount of spread, we think that's not enough to compensate for future rises in yields. High yield bonds give you a little extra, around 4, 5, or 6%. However, even that premium is relatively low, and we need to be very selective to find value, which is still around only in a few sectors, in particular the ones linked to the reopening of the economy. What we like the most across the fixed income space today are convertible bonds, which are bonds which haven't been bought by central banks, therefore they are less manipulated and give you an equity option which transforms the bond into an option to buy the underlying stock of the company if that goes up. They are therefore good hedges in an environment of rising economic growth and improving macro backdrop if the economy continues to run well. Therefore, compared to last year, we see that a lot of bets, a lot of investments in fixed income, especially government bonds, are a bit like picking pennies in front of the railway track. And we need to be very selective to find investments that at least have the same upside or more than they have downside. As investors adjust to this new environment, we expect more volatility to come. We wish you good luck for the months ahead and hope you'll stay in touch with us for future updates.
The Alpha Horizon. Thinking different. Acting aware.